Hey everybody, I was scouring the depths of TikTok and found some terrible financial advice, and it can't go unreacted to. We have to respond to it because people are actually watching this and they're listening. We can't let them go astray. Stay tuned. Hey everyone, my name's AJ. This is The Wealthy Idiots. I found two videos specifically just basically spreading disinformation or misinformation, whatever it is, on 401ks. And this advice is just straight up terrible. We're going to break it apart. And I didn't realize that 401ks were a particular controversial topic, but apparently they are. So someone's got to respond to these knuckleheads. And these two videos, both of them are reaction videos themselves. So other TikTokers wearing, in one case he's got a fancy suit on, he looks all professional, and then he's sitting there like, oh yeah, this is all the information, no 401ks, terrible advice. And then you gotta wonder, what is the dude selling? Well, I'm gonna explain that to you, so let's get into it.
1K was never meant as a big retirement plan. A 401k was developed because after the Depression, people were not getting back into the stock market. So they created a 401k to make it easy for the average person to get into the stock market. So you really got to do some research. Everybody, all of us need to really do our research when we're looking at just blindly accepting advice from somebody. So I don't think today you can save yourself to retirement. The interest rate's 2%, right? It was almost negative because it was zero something, and the fees you're paying brings you negative. So if you're saving money, are you trying to build as big a nest egg as possible to live off of? And who knows what's going to happen with inflation, deflation? There's so many factors. So I don't think saving and a 401k is a good financial retirement plan at all. I think it's probably some of the worst advice you could get today.
What is she even talking about? That was nuts. And the guy down at the bottom yeah, this is all the true stuff you gotta listen to. Alright, let's break it down. So, first of all, 401ks were invented in the late 70s, I think 1978, and it was kind of invented on accident because what the IRS attempted to do, or they changed the tax code, it's called 401k, deferred payment plan, and what it says is if you're not actually paid the money, the government can't tax you, and so by default the 401k, so the company could hold on to some of your money for you, and then that would lower your tax burden. And then it became, and that was actually called a 401k, and that's the line in the tax code, and that's where the name comes from. And then the company is able to actually hold on to that money, so you're not actually getting paid that 401k money. The company's keeping it, and it's technically still in the hands of the company. Now you get a little bit of power. You get to invest it, choose how it goes. 401k plans have a myriad of options as to how it's going to be invested, and you put the money into that and don't think about it. And then if you don't take withdrawals from it before a certain point, there's no penalty, and you don't have to pay taxes on it till you get there. So I don't know where she's getting this idea normal people can't get the stock market, so they invented a 401k after the Great Depression is already wrong. The second thing that she said that was a contradiction of herself was she said, we needed a 401k to invest in the stock market, that's why it was created. Anyways, savings rates are terrible. Those two things aren't equal to each other. A 401k is not a savings plan. A savings plan is you put your money in the bank and you get some kind of interest. That interest is usually set based off of what the Federal Reserve is setting that interest rate at, and it's usually crazy low. 2% is pretty high on a high interest yield account, but at some points it's been there, so that's maybe what she's referring to. A 401k is a tax-deferred account that you invest into stuff. There's not a 2% return. It's not based off of what the Federal Reserve is setting it at, because that you can put it into a variety of different things that are both allowed by law, and then also the company is providing that you're going through for that 401k, and you get to invest it in the actual market in things like mutual funds, index funds, etc. And then those returns are what you're going to end up getting. Those returns over time have an average of about 10 to 11% a year if you count the entirety of the S&P 500. So I don't know where this 2% comes from, but 10% a year is more realistic. Deflation, inflation, your accounts go up and down. That's true for any kind of investing. All investing has that. You're going to go up and down. Some years you're going to go down. Some years are going to be way high. Average, you're going to hit about 10 to 11%. That's how it normally works. And the biggest part that she's totally missing here, which just seems crazy to me, is the employee matching part. Like if that didn't exist, maybe you could make an argument that like, 401ks sometimes have fees, and also, you're never guaranteed, you can lose money. I've lost a bunch of money this year in my 401k, but you know what? I expect that to come back. I'm not making withdrawals from this for at least the next like 30 years. So it'll come back at some point and it'll be much higher than it is today. So I'm not worried about it. But to ignore the employee match part is crazy. So like there is nothing that you can put your money in that will double. So companies will give you 50, 75, or like 100% back match on your money for a certain percentage of your income. So it's usually up to like 6%. You at least have to put in that 6%. I'm not saying you got to hit the maximum of the cap for the IRS allowed, which I think is like 14K or something, but you at least have to get the match. You're doubling your money instantly. There is nothing that, so when she says 2% here, like, oh, I got to put your money in savings and it just grows what, 2%? No. Day one, it grows 100%, and then it grows 2% after that, which means that your original investment is growing like at 4%, even if she was telling the truth. But if it's a 10% return, your original investment is actually growing at a 20% return rate, compounding per year. You can't beat that. There's nothing that can compete with that. So I don't know where she's getting this. She finally makes the statement, don't blindly trust what you see on the internet. And she's absolutely right, because she gets the entire thing wrong in this little clip, and the guy beneath her is just like, this is it. Listen to this. All this is true. Don't listen to it. At least hit your employee match rate, whatever that is. If it's 3%, 5%, 6%, at least hit that. It's basically free money. Just take it and don't even think about it and run, because there's just nothing else you're going to have that's going to beat that. I have another point too, but let's watch the second video and then I'll hit that point at the end of the second video here.
It's a lie that we are all taught about money is we should put it in a 401k and max it out as soon as possible. You see, when you put your money in a 401k, you give up control of it when it's worth the most. Because of inflation, your money is worth less tomorrow, the day after, let alone when you're 59 and a half. But we're told it's great because we defer our taxes. Problem is, taxes don't go down, they go up. So, are they going to be more in the future or less when you end up paying them? Also, your money is invested in the market when you have it in a 401k. Therefore, you should be getting taxed at capital gains rates. But with a 401k, when you take the money out, you're taxed at earned income rates, which is higher. A 401k also offers no protection. If the market drops, so does your money. So you give up control and access to your money when it's worth the most to pay more taxes in the future and be taxed at higher rates. The whole time, you've got no insurance on your money. To learn a better way, follow me.
There was a lot to unpack with that one. I think we're going to have to rewatch it and kind of pause and go through it bit by bit, because there's a lot of information in there and even contradicts himself a few times. So let's hit it.
The biggest lie that we are all taught about money is we should put it in a 401k and max it out as soon as possible.
Now, all right, like I said, you don't have to max out your 401k. You could just hit the employee match if that's what you want to do. I would take the difference. So like if the max of your 401k is like 10% of your income and you're going to only put in 6% because that's what the match is, take that difference and then go put it into the stock market yourself, buy index funds yourself, or do something with it. Don't just spend it. You want to keep investing that. I understand you might want more control over stuff. You then get the capital gains rate, etc. But at least hit that employee match.
You see, when you put your money in a 401k, you give up control of it when it's worth the most.
I don't have any idea what that means. Yeah, you don't have control of your money in the sense of like you can't withdraw it without penalty. It's tax deferred until you hit a certain point of retirement, and then you have to start withdrawing and you'll pay taxes on that point. But you can still choose how it's invested. Your 401k gives you options as to like where you're going to stick it, what your risk tolerances are. Your decision-making ability on that. So I don't know what he means by you lose control. Maybe he means like you can't take it out without penalty, which is fine. You don't need all your investment. Like if you're going to do like a 20, 25, 30% of your portfolio investing, it's okay if 6% goes into this because you're getting that match, that employer match. Like you can't beat that.
Because of inflation, your money is worth less tomorrow, the day after, let alone when you're 59 and a half.
Okay, again, it's not a savings account. You're not just throwing money into a 401k and just having that cash sit there. It's getting invested. You're picking the investments. It's the same as if you get a brokerage account. Usually 401ks are limited. You can't choose like any type of investment. They have very specific ones you can pick from, but they're very trusted and usually the high-end investments that you'd probably pick from anyways if you were to go invest your money. It's not losing value if the market is improving at 10 to 11% per year and inflation is below that, right? But then again, he's going to say in a second about how your money's invested. So he says your money's sitting there and losing value, and also it's not sitting there and it's invested and it's not invested right. And you're like, there's like what you can't be, you can't be dishonest when trying to convince someone to do something like this, because then at some point someone's going to call you out and see through it.
But we're told it's great because we defer our taxes. Problem is, taxes don't go down, they go up. So, are they going to be more in the future or less when you end up paying them?
So this is actually true, and what he's saying here is like there hasn't really been a time in U.S. history where taxes have gone down. Like if you're let's say like middle class, whenever the income tax was passed originally back in, was it like 1916 or something like that, 1917, only the top 2% of income earners were paying taxes at the time. You were paying zero if you were in the middle class brackets. And then slowly over time, that's been increasing and taxes have been going up. And if you look at a chart of tax rates, it's like Republican gets in office, Democrat gets in office, Republican gets in office, Democrat gets in office. And at the end, we're left way up here, like everybody's tax rate goes up. So what he's claiming is like, okay, you're not paying taxes on it today when taxes might be actually lower than what they are 30 years from now when you start withdrawing the money. The difference, however, is that, and I explained this before in a previous video, is that you don't have to withdraw what you make today in order to survive in retirement. So a good example is someone who like lives in the Bay Area. You are paying a crazy amount to live here. You make fairly good money. Let's say you work in tech and you're putting money into your 401k. Well, at some point, you're probably not going to remain here. You're going to skip on out of town, go to some place where it's way cheaper to live. And instead of your lifestyle costing you like 150 grand a year, your lifestyle now costs you 60 grand. And it's the same lifestyle as it was, back at that time. The other thing that's important here is inflation does count. So like as he's saying, so middle class, what's going to be middle class in the future is not what is middle class today. So if we end up having to withdraw 150,000, the taxes on that 150,000 might be less because that 150,000 is not going to be as impactful 30 years from now as it is right now. So the tax brackets are going to shift as inflation goes up. And when you finally get to that final point where you're withdrawing for retirement, you don't need as much money as you do when you're working and like buying, like paying for mortgages or, trying to invest, because you're not investing anymore. Now you're just living. So you need less money. So you're probably going to be in a lower tax bracket. Worst case, maybe the same as you are today. It doesn't really change anything.
So your money is invested in the market when you have it.
So it's invested in the market, or is it in savings and losing value?
In a 401k. Therefore, you should be getting taxed at capital gains rates. But with a 401k, when you take the money out, you're taxed at earned income rates.
That is true. So capital gains, like if you were to take your taxed money, your personal cash that you have in your bank account, and you go buy something like Tesla stock, and then let's say that Tesla stock's $1,000 a share, and 6 months from now you sell it at $1,000 a share. You don't pay any taxes. Capital gains tax is you pay a flat rate of taxes, and I think it's like 20% for short term and like 30-something% for long term. So what that means is as long as you've invested for over a year in that thing, whatever the difference is that you made in that investment is what gets taxed at that rate. So let's say we sell Tesla at 100, or let's say we bought it and then 1 year from now, or at $1,000, 1 year from now we sell it at $1,050. We're only paying the tax on that $50, and we're paying 20%. So that's what he's referring to. Whereas with the 401k, as you're withdrawing it, you're paying income taxes on that like you're making an income. And technically that's true because you don't actually get the money. The reason that it's not taxed is the company is keeping that money for you, and it's technically the company's money in a promise that's enforced by law to give to you at the point of your withdrawal time frame. And when they finally give it to you, they're giving it to you as income when it gets to that point. So essentially what occurs here is like you're not really investing your own money. You're letting the company keep a portion of your money in exchange for giving you more money when you finally retire, is essentially what it is. It's like buying income past the time that you work for that company is essentially what you're doing. And if they're matching it, you're getting like more pay. You're basically saying, like, instead of paying me, that $1,000 today. How about you take that $1,000 and you pay me $2,000 plus interest 30 years from now? That's exactly what's occurring here.
Is higher. A 401k also offers no protection. If the market drops, so does your money.
True. That's how investing works. However, if the market drops and you're continuing to buy, this was the point I was talking about earlier, you're lowering your average purchase rate because everything's going on sale. So you're getting to buy everything for cheaper. And then as the market comes back up, you now lower your cost, what's called dollar cost average. And we'll talk about that more in the videos over here.
So you give up control and access to your money when it's worth the most to pay more taxes in the future and be taxed at higher rates. The whole time you've got no insurance on your money. To learn a better way, follow me.
Okay. Yeah, there's no insurance on your money in the sense of like, yeah, if you lose some in the market, you lost it. There's nothing you can do about that. However, market has a habit of going up over time, and with inflation, that also pushes the market up over time. So what is dollar cost averaging? And what he's kind of missing here at the end. Dollar cost averaging is where you're just buying, in increments. And instead of thinking about like, is this the lowest time to buy? Is this the highest time to buy? Is this the middle time to buy? You're just going to keep buying. And as the market starts dropping like it is now, your 401k is going to keep purchasing because it's a percentage out of every paycheck. So it purchases. So yeah, like your overall value of your 401k has dropped. Mine was much higher. It's lost quite a bit of value, probably under 50, maybe like 35 to 40% of its value has been lost. But I've been buying as the value is all down here. So when eventually, even if it's 3 years from now, 5 years from now, and we're going through this inflation and the recession stuff is difficult, I'm going to continue to buy. And when we finally hit that point, it's going to start climbing back up. I'm going to have bought all this stuff down here, and all of that is going to be growing. And when we hit the match point for my original purchase, that'll be even, but all of this will have been bought in the meantime. That means the average purchase rate of all of the stuff that I'm buying in my 401k is dropping as I keep buying the lower and lower cost stuff. I usually call this buy when things are on sale. The stock market's on sale. Now's the time to buy stuff. Get into it. What are they talking about here? And why are they really fighting this whole 401k thing? Like, if you could double your money instantly with the employer match, why are we even worrying about things like what the tax rate is going to be? Is it going to be double? No, it's not going to match that tax rate. So like, why are we even worrying about it? Furthermore, for most people, you get a tax credit for having put money into retirement. So you get money back on your taxes unrelated to this, not just the fact that you can count less in your tax rate, but you actually get a tax credit back for having put money in your retirement. So you get more money as a result of having put this in there. So why are they fighting this so hard? Well, their language indicates, and then I had to look this up and I found out both these two gentlemen who are at the bottom wearing the nice suits looking all like financial advisors turn out to be insurance salesmen. So we've talked before about, possibly looking into whole life insurance as an investment strategy, as a savings tool, as a savings strategy. And I'm still researching that. There's a lot to look into, a lot of information, and I'm still trying to decide if it's the best thing for me and my family. Some of the plans that I found have like a 30-year balance rate. That's a little bit too long for me. I would need something that balances closer to 10, and so I'm still hunting, but I will get back to you guys with more episodes on that sometime in the near future. But it's a savings tool that guarantees a certain amount of interest, and it guarantees that you can't really make losses as a result, and that's the language that they're using. You don't want your money to go down. You want it backed up by insurance because the states back up life insurance money for if the company goes out of business or if something were to happen. You can't go negative interest. Interest rates are usually somewhere between 4 and 5%, which is pretty decent. That doesn't count the fees that you're paying as a result of the whole life insurance. That's a different topic, but 4 or 5%. So if you compare that against like savings accounts where the highest you could get is like 2%, you could see why she's saying, like, why would you pay 2% when you could get something better that's insured that makes more sense? And then in this case, he's saying, why would you put your money in something that goes up and down when you could buy something that only goes up? The difference is it only goes up like this, whereas the stock market goes up and down like this. And at the end, we're going to end up here and he's going to be somewhere down here. Whole life insurance, if it does work out as a plan, as I'm investigating, is not a replacement for investing. It is especially not a replacement for investing when the employer is matching your contributions to this plan. So Don't listen to them. If whole life insurance is a good plan for you, that's separate from what you're doing with your 401k. Do not miss out on the benefits you're getting in your 401k to go give these guys money and then not see those same benefits. It will not set you up for retirement. It is not a plan that's supposed to be for investing and really building wealth. It literally is a savings account that you could, if it is what it is, if it is what I think it is, it's a savings account that you can store money with a decent interest rate that can be then used to invest at some point in the future when the opportunities arrive. That's it. Anybody selling you on something differently is blowing smoke. And if they're telling you not to invest when you could double your money instantly, you already know they're lying to you. So if you disagree with me, please let me know in the comments. I would really like to know if you got a better argument than I have. Maybe we can cover that. That'd be awesome. That's all I got for today. I hope you learned something. We're going over some interesting topics, some stuff I really didn't think I'd go over, like who actually argues against 401ks. But it's interesting. In the meantime, between now and our next episode, check out wealthyidiots.com. Please like and subscribe. Smash that like button. It helps us out tremendously. We can get more of this information out to people who really need it. These videos had millions and millions of views. Our videos have thousands of views. We need you to push this stuff so people can get the right data and become passionate about finances and become financially independent like the rest of us. Thank you so much for stopping by. I'll see you guys next time.